Hey guys, welcome back to Andrew Invest. Another huge week for my portfolio last week as both Apple and Crocs reported earnings, and it was mixed for both of them, but decidedly worse for Crocs as it fell nearly 17% after reporting. But were the earnings as bad as what the market was implying? Well, today I want to go through both of them and explain why I think these stocks are still a hold. But first, here's the question that I keep asking myself: was I wrong about Crocs? For the past 2 or 3 quarters, Crocs posted great earnings but ended up selling off anyway. And on that basis, I ended up buying more shares in the company. But this time it's a bit different. The earnings were really poor and guidance wasn't great either. So what gives? What has changed so drastically for the company? Well, it's really been a tale of 2 brands for Crocs here. It has 2 major brands under the parent company, Crocs and HeyDude. HeyDude is a sneaker company that was acquired back in 2021 for $2.5 billion. Now, the company took out a huge amount of debt to pay for this, and it was expected that HeyDude would be the primary growth driver for the company in the future. And whilst that originally seemed to be the case, it has now slowed down, and this quarter we've actually seen a decline in growth for HeyDude. Whilst HeyDude has been struggling, the Crocs brand has been going from strength to strength, with revenue increasing 11% year on year, and even the tough North American market, where footwear sales are declining overall in the market, increased 8% year on year. But the most impressive thing was its Asia sales, where revenue growth was massive and countries like China had 90% plus revenue growth. Australia had over 100% revenue growth. Those are really impressive figures and really shows the strength of the Crocs brand and the pricing power they have. They were actually able to increase operating margins for the Crocs brand over this period, and that's really impressive with the consumer market struggling globally. But HeyDude does not have the same kind of brand power that Crocs does, and that's been reflected in the margins this quarter, which has lowered significantly as the company has had to put lots of the shoes on sale in order to drive more revenue. But the problem is that revenue has actually declined year on year, which would imply that the sales have not made that much of a difference in demand for the shoes. So it's not really looking very good for the brand at all. The only silver lining I would say there is to this cloud is that when we look at the breakdown of revenue for HeyDude, it's actually increased its direct-to-consumer sales, and direct-to-consumer sales increased by 15%. And most of the decline in revenue has been from slowing revenue growth in wholesales. Last quarter, Andrew Rees went on CNBC to explain why HeyDude sales growth was decreasing. And he basically said that retailers are seeing declining economic conditions for consumers, and thus they're a lot more conservative with what types of shoes they want to buy and put on stock. Similar logic was said at this quarter's earnings call.
Wholesale revenues were down 20% from Q3 last year as we continue to lap pipeline fill and as lower consumer footfall led to retailers taking a more conservative approach to at-once orders.
After all, they don't want to have to manage a large inventory of shoes that they're not able to sell. And HeyDude is a relatively small brand. So is it really a case of retailers seeing declining demand for HeyDude, or is it a case of them just not wanting to take the risk on a relatively small brand? Well, there are some clues that we can look at. Just look at the direct-to-consumer sales of HeyDude, which actually increased 15% year on year, whereas wholesale was pretty much what dragged the overall sales down so much. In addition to that, the recent Taking Stock with Teens Piper Sandler survey was released. This is a survey that queries teens on their favorite brands, and I find it's really useful for getting an idea of the consumer market, especially when it comes to brands that sell directly to consumers like Crocs. So when we actually look at the figures for both Crocs and HeyDude, we can actually see that they've increased their popularity compared to the last survey. That doesn't really point to HeyDude's slowing growth being because of falling demand, but the projected guidance for HeyDude revenue growth in Q4 is really bad at -20 to -25%. So I think it's going to be really important to keep a close eye on DTC revenue growth in Q4 for HeyDude and whether it remains positive or not. Other good news for the business was that they were able to pay off $90 million more of their debt that they accumulated when they purchased HeyDude. And in addition to that, they bought back around $150 million worth of shares. Now, they did acquire those shares at a relatively high price, over $100, so it doesn't represent amazing value to the shareholders since the share price has dropped a lot since then. But it does mean that future share buybacks will have a lot more bang for their buck because they'll be able to buy a lot more shares whilst the share price is so low. Overall though, the market has priced Crocs as if it's about to collapse tomorrow. It's trading at an 8 price to earnings ratio, which implies zero growth or declining growth over the next decade. And don't get me wrong, that could potentially happen, but I don't think it is that likely, and the stock is so cheap already that even if there is declining revenue growth, the stock still represents value. I'll show you on a DCF chart. For my Crocs DCF, I've used some relatively conservative figures that I think are achievable by the company over the next decade. So I put 10% for the discount rate because that's the S&P 500 average return. And I do think that Crocs is not a high quality stock on the same kind of tier as Visa, so I will use the S&P 500 as a comparison. Revenue growth, I put 6%, which is below historical levels over the last few years, but I could see some potential headwinds from HeyDude, so I will put it a little bit lower. EBITDA margin and capex margin I've put as the historical levels of 26% and 2.6%. With these numbers plugged in, you can see that the fair value of the stock is $218, which is around 2.5 times where the stock is today. So the market is pricing in some really bad times for the stock. If I actually vary the revenue figures, I can see what the stock would be with 0% revenue growth. The fair value is around $136 per share, which is still significantly higher than where the stock is today. Even if I decrease the revenue to being negative growth, I can see that the fair value is still significantly above the current price at 117 if the revenue growth is minus 2% over the next decade. It's only if I reduce revenue growth to minus 5% that I can see the market basically pricing the stock as fair value today. So the market is really pricing in really bad times for the stock, and if it doesn't do that badly, the stock will go up. Touching on Apple's earnings, they beat on both top and bottom line expectations again, although their revenue and earnings per share were less than what they were last year. The key highlights from the report was that iPhone sales are still growing compared to last year. Even though critics say that each new iPhone is exactly the same as the last, people still keep buying new ones. And it really shows the brand power of the Apple iPhone and the ecosystem in general. But the most impressive thing about the report was service revenue growth, which grew 16%, and it really shows that transition into a service-based business that Tim Cook initiated, paying dividends, figuratively and literally. One of the main things from the report that I wanted to discuss is also one of the main negatives, and that was MacBook sales. MacBook sales dropped significantly compared to last year, and that's reflective of a really tough consumer environment, especially when MacBooks are extremely expensive, especially for an average consumer at around $2,000 each. But Tim Cook was relatively positive about the outlook for them next year, especially with the M3 MacBook Pro being announced earlier this week. I think it's really interesting that since Apple started making its own chips, not using Intel chips, the market share of MacBooks has increased by a good amount. And in addition to that, the processing power and performance of the MacBooks have also increased significantly. Apple creating their own chips means that they can optimize their software to their hardware in a way that Intel and Microsoft can't, for example. So I think it's really interesting, and there's potential for Apple to potentially grab the lion's share of the profit in the personal computer market, in the same way that it's done in the smartphone market, having around 50% of the sales but 90% of the profits. Overall though, I think Apple stock is quite expensive on paper, and although I do agree with analysts that it will reaccelerate back into growth next year, I won't be buying any more of the stock, but I also won't be selling. I think it's such a high quality stock that it's basically just a long-term hold, whatever the price to earnings ratio is. With regards to Crocs, I do think that the prospects are somewhat dimmed, but I do think that the share price is still heavily undervalued, with the market pretty much pricing in absolute catastrophe for the company. So I will be picking up a few shares here and there at the current price, but I don't want to make it too large a position in my portfolio, as the company is very volatile and there are large risks with it. So those are my thoughts on both of these companies' earnings. Let me know what you think in the comments below. And if you did make it this far, please leave me a like and subscribe. I'll see you guys next time.